Trading is a field where, if you simply memorize patterns, you will never become a consistently profitable trader. You must always understand the logic behind every trading concept. You may have heard on YouTube in a trading course or from a book that after the three white soldiers pattern, the market moves up. Most people accept that without questioning it, but I don't. I always ask, why does the price go up after three white soldiers? Similarly, after three black crows, the market is said to move down. I don't just accept it. I ask, why should the price fall after three black crows? In short, you must understand the psychology and logic behind every concept instead of memorizing it. That's exactly what we'll learn today. We'll understand the psychology behind candlestick patterns and why a pattern becomes bullish or bearish. Let's start with the basics. There are two primary types of candlesticks, green and red. The thick middle portion is called the body. The thin lines above and below the body are called the wicks or shadows. The upper shadow is called the upper wick, and the lower shadow is called the lower wick. In a green candle, the opening price is lower than the closing price. In a red candle, the opening price is higher than the closing price. The highest point of the candle is called the high, and the lowest point is called the low. Candles are generally classified into three categories: bullish candles, bearish candles, neutral candles. A bullish candle suggests buying pressure. A bearish candle indicates selling pressure, while a neutral candle shows market indecision. Many traders assume that every green candle is bullish and every red candle is bearish. However, that's not always true. Sometimes a green candle is followed by a sharp decline, and sometimes a red candle is followed by a strong rally. That's why you should never judge a candle only by its color. Let's understand different types of candles. 1. Strong bullish and strong bearish candles. Suppose the price opens lower, buyers push it upward, and it closes near the highest point. This is called a strong bullish candle because buyers completely dominate the market. How do we know sellers were absent? Imagine another candle where buyers initially push the price higher, but before the candle closes, sellers enter and push the price slightly lower. This creates an upper wick, indicating that sellers participated in the market. If a candle has a very long lower wick, it can still be considered a strong bullish candle because sellers initially pushed the price lower, but buyers completely overpowered them before the candle closed. Now let's look at the strong bearish candle. The price opens higher, sellers aggressively push it downward, and it closes near the low. This indicates that sellers dominated the entire session. Even if the candle has a long upper wick, it can still be considered a strong bearish candle because buyers tried to push the price higher initially, but sellers completely took control before the close. Normal bullish and normal bearish candles. Suppose buyers push the price upward, but before the candle closes, sellers pull it back slightly. Now imagine dividing the candle's body into two equal parts. If the upper wick is less than 50% of the body size, the candle is considered a normal bullish candle. Similarly, if sellers push the price downward but buyers recover part of the move before the close, and the lower wick remains less than 50% of the body size, it becomes a normal bearish candle. Number 3. Weak bullish and weak bearish candles. Suppose buyers push the price higher, but sellers enter aggressively before the close and force the price down significantly. If the upper wick is much larger than 50% of the candle body, it is called a weak bullish candle. Likewise, if sellers initially push the price lower, but buyers strongly reverse the move, creating a lower wick much larger than 50% of the body. It becomes a weak bearish candle. It's generally better to avoid trading weak candles because they indicate uncertainty and reduced momentum. Strong and normal candles usually provide more reliable trading opportunities. Hash 4. Hidden bearish and hidden bullish candles. Suppose buyers push the price sharply upward, but aggressive sellers step in and force the candle to close much lower. Although the candle remains green, its behavior is actually bearish because sellers dominated before the close. This is called a hidden bearish candle. Many traders become confused because the candle is green. However, instead of focusing on the color, you should analyze the behavior of buyers and sellers. If the next candle breaks the low of a hidden bearish candle, especially near an important resistance or supply zone, it can provide a high probability sell setup. Many traders confuse a strong bearish candle with a hidden bearish candle. The difference is simple. A strong bearish candle is red. A hidden bearish candle is green, but behaves like a bearish candle. Now let's look at the hidden bullish candle. Suppose sellers push the price sharply lower, but buyers aggressively step in and push the price much higher before the candle closes. Although the candle is red, its behavior is actually bullish because buyers dominated by the end of the session. This is known as a hidden bullish candle. 5. Neutral candle. The final type is the neutral candle. In a neutral candle, the opening and closing prices are almost the same. Both the upper and lower wicks are nearly equal in size. A neutral candle represents market indecision. If the market later breaks above the high of the neutral candle, traders can consider a bullish trade. If the market breaks below the low, traders can consider a bearish trade. Final advice: never make trading decisions based only on candlestick patterns. Always combine candlestick analysis with market structure, support and resistance, volume analysis, supply and demand zones, overall market context. When these concepts work together, your trading accuracy can improve significantly. If you found this lesson helpful, don't forget to like the video and let me know in the comments which trading topic you'd like to learn next. Thank you for watching and happy trading.